More people will come in the market, the values of the homes will increase, and right now the market is very balanced because we see that the stock market is actually doing very well. However, on the day of the election results, when BJP did not win with a majority, you see a sudden spike in the bond yields. The bank governor has said that they will be cutting more interest rates this year. How does it impact your mortgage eligibility? Should we go with a variable rate mortgage or a fixed rate mortgage? And the answer in general is
the Governing Council decided monetary policy no longer needs to be as restrictive and lowered the policy rate by 25 basis points to 4.75%.
Finally, Bank of Canada has cut interest rates after 4 long years. Today's video is going to be extremely important and I'll be talking about nuances of interest rates, what you as a first-time homebuyer should do, and more importantly, what's gonna happen in the next interest rate announcement going forward. So let's get started. So in today's video, we'll be talking about what happens when Bank of Canada cut rates and how does variable rate and prime rate gets impacted. There are different terminologies that are used in the interest rate world, in the mortgage world. I'll be actually explaining you all those terminologies and how each of them is used in different contexts. Then I'll be talking about how does it impact your mortgage eligibility. After that, I'll be talking about will this also impact fixed rates, because there's a massive myth out there that if variable rates go down, fixed rate have to go down, and that's not true. And finally, we'll be talking about what should you do as a first-time homebuyer. Should you buy in today's market or not? And if you are buying, whether you should look at a variable rate or a fixed rate. So on June 5th, 2024, Bank of Canada has cut interest rates to 4.75%. That's the key interest rate, which is also called the benchmark rate, that is reduced by 0.25%. Now, I will explain the difference between a benchmark rate, a prime rate, and a variable rate that you and I get at the bank, but I'll do that in the subsequent slides. But the most important thing to note here on this particular slide is that the bank governor has said that they will be cutting more interest rates this year. This makes sense to me, kind of, barring the fact that I don't always agree to how they calculate inflation, but just, keeping that aside, the reason why they were not reducing interest rates for such a long time and they've been just increasing interest rate is because they wanted to control inflation. I think by now we all know that. Right now, Canada's inflation is actually coming down. It's at 2.7%. Now, I'll not get into the controversy of, what's included in inflation and what's not. But as reported on May 2021, these are April numbers basically, because there's a lag of 1 month on the inflation numbers. We are at 2.7%, which is very close to 2%. And therefore, Bank of Canada decided to reduce the interest rates by 0.25%. Rate cut happened on June 5th, and the next announcement is going to happen on July 24th. And by then, there will be the May inflation numbers that will also come out. And then it will be interesting to see how Bank of Canada responds, whether they will be reducing another 0.25% or not. But this particular decision of Bank of Canada is also impacted by what decisions US Feds take on their interest rate policies. And if I look at US, the US inflation numbers are not as low as 2.7. They are actually at 3.27. Yes, they are coming down in the last, few cycles, but still, they are above 3%. And therefore, US has actually decided not to reduce their interest rates. And they have also given an indication that they'll only be reducing the interest rate once this year. So the indications that are given by Bank of Canada and the indications that are being given by the US are very different right now. Now, Canadian economy is highly dependent on the US economy, and if Canada decides to cut interest rates way faster than the US economy, then what would happen is that there is a risk of currency depreciation, and that will not be good for the Canadian economy. And therefore, I feel that yes, right now the numbers look pretty good. Right now, the governor is saying that, they might cut more interest rates, but I would be highly surprised if they do more than once or twice this year, especially when US is being very conservative on the interest rate cuts. Now, regardless of what happens in July or the remainder of the year or next year, I think there are certain basic things that we need to understand when it comes to interest rates, because this is one question that I get a lot. Now, Bank of Canada cuts key interest rate to 4.75%. Now, a lot of people think that this 4.75% is the interest rate that they actually pay, and that's not true. There are 3 types of interest rates that you will hear very loosely in the market. One is the key interest rate, which is what you always see when Bank of Canada cuts or increases interest rate. Then there is a prime rate, and then there is a variable rate. Now, let me explain all these 3 terms and how they are different in terms of numbers and in terms of basics. So key interest rate, prime rate, variable rate. Right now, the key interest rate is at 4.75%, which is 0.25% than last month. And this key interest rate is also called benchmark rate, overnight rate, policy interest rate. So whenever you see these terminologies, you know that it's the same thing. Now, what exactly is this key interest rate or benchmark rate? The interest rate at which banks can borrow when they fall short of their required reserves. Now, we all know that banks do not keep all the reserves. They actually invest all that money. But when they have to give a mortgage to someone, they have to take funds and they have to pick the funds from somewhere. And now a lot of times they actually borrow from other banks or other institutions, and that's the rate that they have to pay for borrowing that money. And that basically is called the key interest rate, or 4.75. That's their cost. That's their fixed cost that they have to spend whenever they take a loan to give it to someone else. Now, as I've already said, and you already know that banks never lose money. So if this is the cost, they have to put in their costs of employing people, of having branches, of doing all the paperwork, and they also have to include the profit margins, and that's where the prime rate comes from. The 2.2% gap between the prime and key interest rate covers their costs and margins. Now the question is, what the heck is a variable rate, and what is it that you and I pay, and how is it different from prime? Now, if you are on a variable rate mortgage, or if you know how variable rate mortgages work, you would know that they actually discount on prime. So what I mean by that is, for instance, my condo is on prime minus 1%, which that means is if the prime rate is 6.95%, my rate that I pay for that particular condo, the interest rate will be prime 6.95 minus 1%, which is 5.95%. And this is as simple as competition, and banks offering the 5-year variable rate at a discount of prime to compete with other lenders. Because if the lenders were independent and there was no competition, they would actually sell everything at prime. Now, loosely speaking, if there was only one bank in Canada, there's a very high chance that our variable rate would have been prime minus 0, which is 6.95%. But competition always puts pressure on margins, and therefore the variable rate that we get is prime minus 1%, because they're trying to compete amongst themselves. The banks are competing for your business, and therefore they give a discount on the prime rate, hence reducing their margins by a little. So that's the difference between key interest rate. So whenever you see key interest rate, benchmark rate, that is not your interest rate. They have to put margins on top of it, and then they give a discount, but they still make money in the process because banks never lose money. Now that the interest rates have come down by 0.25%, let's try and understand how does it impact your mortgage eligibility. Will it increase? Let's say you were able to, buy or get a mortgage of $500,000 before the interest rate decline, and now can you be eligible for 525? And the answer is no. And the reason for that is that unless you were going for a variable rate mortgage, you were already getting qualified for a way lower interest rate. Let me explain that with numbers. Now, most people right now are taking a fixed rate mortgage, and therefore we were already qualifying people for less than 5% interest rate, because the 3-year fixed interest rate right now is under 5%, especially if you're doing a less than 20% down payment. Now, just to put things in context, let's say you were to take a variable rate mortgage before the rate decline, which, this 0.25%, your prime rate would have been at 7.2%. And therefore, with a 1% discount, let's assume you're getting a 1% discount on of prime on your variable rate, your rate will be 6.2%. And as you know, in Canada, we have to do something called a stress test, where we need to qualify people at 2% higher than the interest rate that you are getting on your mortgage, and therefore we have to qualify this person at 8.2%. Now that the interest rate have declined, we have to qualify still people at 7.95%, because the fixed rates are already way lower than variable rate. We were already qualifying people at 7% because the fixed rate is under 5%. And therefore, yes, the interest rate have declined by 0.25%, but we were already qualifying people at way lower at the fixed rate, and therefore eligibility actually doesn't change at all. It is too early to say this right now, but if Bank of Canada continues to reduce interest rate, there's a high chance that more people will come in the market, the values of the homes will increase, and because we were already qualifying people at fixed rate, which is way lower, the eligibility will not increase at that level, and we would have problems with eligibility in the market, because now the values would have increased and our eligibility remains the same. Now, by the end of the video, you'll also know whether you should pick a fixed rate or a variable rate now that the interest rates are coming down. But we'll talk about that in a bit. The other question that a lot of people ask is, if variable rate is going down, will the fixed rate also go down? The answer to that is also no. And let's first understand how variable rates move and how fixed rates move. So variable rate is dependent on key interest rate, the benchmark rate the Bank of Canada actually is doing to control the market. And what they are trying to control, as we all know, is inflation. When the inflation was very high, they need to reduce inflation. For that, they have to increase the interest rate. That puts pressure on spending, and therefore the demand for mobile phones, demand for holidays, demand for everything goes down. That puts downward pressure on the economy, and therefore the spending actually reduces. And when spending reduces, inflation comes down. So variable rates are very much in the hands of Bank of Canada. Of course, there are economic scenarios that they need to look at, but it's basically used to control inflation. On the other hand, fixed rates are dependent on the market and the government bond yields, and no one can directly control these bond yields. Now let's first look at what bond yields are. So I'll talk about bond yields a little bit in the next slide, but this is a chart for the 10-year bond yields. Bond yields are nothing but the return on the government bonds that you invest in. As institutional investors, they are big investors who are investing a lot of billions of dollars, and in return, they get a steady return, which is not crazy high, but it is guaranteed. Now I will explain the correlation between bond yields and fixed rates in a bit. However, just overall high level, if bond yields go down, fixed rates go down. If bond yields go up, fixed rates go up. And just hold that thought, because I will explain why bond yields go up and why bond yields go down in my next slide. But you would see that, let's look at July 5th announcement. So July 4th was when the bond yields were at a certain level. On July 5th, when the interest rates declined, yes, the fixed rate or the bond yield also declined, but it was temporary. It was just a knee-jerk reaction from the market, where they thought that yes, the inflation has come down. Yes, Bank of Canada is now reducing interest rate, and therefore they trusted the government, and therefore they started putting their money into government bonds. But that was just a knee-jerk reaction for one day on the interest rate announcement, and that happened, and then it started going back up. And I don't have numbers for today, but today also it has gone up slightly. Now, like I said before, if variable rate goes down, it does not directly impact the fixed rates and the bond yields. Now, let me explain how bonds work and how bond yields are impacted, and therefore the impact of that on fixed rates. Now, let me explain this as simple as possible in layman language. Let's say that you have $1 billion to invest in the market. You have two options there. One is that you can invest that into the stock market or the capital market, which are basically huge real estate investment funds, mutual funds. That is one vehicle that you have where you can invest the $1 billion of, or part of it is invested there. The other one is that you can also invest that money into government bonds, because you feel that the capital and equity markets are actually not doing that well right now, and therefore you want some safety in this money that you have, even though you make a lower return. And therefore, instead of investing that into the capital or the equity markets, you invest that money into the government bonds. So the decision that we are trying to make is, who do investors trust more? Let me give you an example now. So in COVID, what happened was the government actually won, because in COVID, let's say, it was this area, and these are the bond yields of Canada, again, 10-year bond yields of Canada. Now, what happened was that during COVID, the bond yields actually came down. The reason why they came down is because there was so much commotion in the markets. People didn't know whether they'll live or die. The companies had a hiring freeze. They were losing business left, right, and center, and the entire stock market collapsed by a lot. And the only safe haven for all the institutional money was the government bonds at that time, because they were the most stable form of investment, and the money had to go somewhere. So in this case, what happened was people started to pull money out of the equity market from the stock market and started to put into a much more safer investment, which is the government bonds. The demand for bonds went up, the bond sticker price went up, and therefore the yields went down. And when government yields go down, fixed rates go down. And that's the reason why we saw sub 2%, 1.5% fixed rates at that time. So this was that time. Then what happened was, when the inflation started to increase, the inflation was, at 8% at one time. Then there were wars that were happening, and people started to lose trust in the government then, and then they started to pump money into the stock market again. And that's where you see the record levels of stock market right now. But what that also does is the bond prices have now reduced, because the demand for bonds had reduced, because people stopped trusting the government for making sound decisions. And because the bond prices came down, the yields, the return from those bonds increased. And when bond yields increase, fixed rates go up. And right now the market is very balanced, because we see that the stock market is actually doing very well. We also see government recovering, because unemployment numbers overall are not looking that bad. Recession is not looking that bad. The GDP is pretty okay, 1.6, 1.7%, both in the US and in Canada. And we are seeing inflation numbers come down, and therefore the economy is becoming a lot more stable. And at the same time, the equity and capital markets are also doing well, and therefore we see a very balanced market right now. In simple terms, if I'm an investor with $1 billion right now, I can actually put 50% of my money into the equity markets and 50% into the bond market just to keep my portfolio balanced. And that's why in the last 6 months, we have not seen a lot of massive movement in the fixed interest rates. Now, this is not just about Canada and US. It works the same way anywhere in the world. Let's take an example of India and the elections that just happened. Now, these are the 10-year bond yields for India. They were at, over 7%. They came down. This is for the last 1 month. So I've just taken a smaller, time frame. They were coming down because the exit poll was saying that BJP will win with a majority, and BJP is good for the economy. I don't want to get into the controversy of, what they are, whether they are good or not. That's not the point of this video. However, for the economy, the indication was that, they will be good if they come in majority. And therefore, before the elections, people started to pump money into the government bonds. The bond prices increase, the yield goes down. Therefore, the fixed rates in India also started to go down. However, on the day of the election results, when BJP did not win with a majority, you see a sudden spike in the bond yields. And the way it works, like I said before, is now that the government was not formed in majority, people lost trust in the government bonds, and a lot of these institutional investors, the foreign investors, started pulling money out of the government bonds and putting the money back into the capital market. And when that happens, the bond prices go down, the yields increase, and therefore the fixed rates also go up. And that's how bond yields and fixed rates work, and they do not have a direct correlation with the variable rate and what Bank of Canada decides in lieu of inflation. So the question now is, what should you and I do as first-time home buyers? And we need to ask the right questions. And this is a repeat slide from another presentation that I did, but this is so important. You should not ask the question, is this the right market to buy? The question should be, am I ready to buy right now? Do I have the emergency fund? Do I have a stable job? Because those are all the more important things that you and I can control, but we cannot control how the market is reacting to all these interest rate cuts and whatever is happening in the market. My bank gave me an eligibility of $1 million. Let's go and buy a house of $1 million. That should not be the mindset that we have. The mindset should be, I need to ensure that my home related expenses, that includes your mortgage payment, your utilities, and your insurance, property taxes, are under 35 to maximum 40% of your net household income, so that you have money to invest in other vehicles as well. You have money for emergencies. You have money to enjoy your life as well. And therefore, it's very important that we don't just go blindly with the bank number. We actually look at our finances and we take a more sound decision. And if it means you do not buy your dream home as your first home, that's okay. This is another thing that I see a lot of people saying. A lot of videos are being made that you should never buy condos. You should always buy freehold home. And I personally agree. I also own a couple of, freehold homes, and they appreciate in value a lot more than condos. However, my first home is not my dream home. I'm living in that house. And if I'm only eligible for buying a condo, why not? And besides, condos are at the peak of their inventory right now, and they are the best asset class to buy if you are looking to buy something at a discount. And I'm a huge believer of buying an asset class that no one else is buying, because that's where you get the best discount and you always make money on the buy on real estate. And it's a really good opportunity for you to buy a condo in this low market. Another thing which is very important to know and I want to highlight is, because of this interest rate decline that is happening, and maybe there's another one which is coming in July, August, whenever, we don't know that. But if it happens, there will be a lot of FOMO that will be created in the market. My realtor says it's crazy market with multiple offers. We have to act now. That might be true, but we should not be doing that. And instead, you have to make sure that you're working with a power team who can still get you the deals under market value, because there are different strategies that my team uses, a lot of good realtors use, to still get you in this crazy market, still get you a really good deal as per your eligibility and as per your numbers. Now, if you are looking to hire a good team, we are a team of mortgage agents who have connections with really good realtors who can actually get you these power deals. And we are also working with the best lawyers, accountants, financial planners in order to make your journey really easy. And if your situation does not allow to buy your house right now, we will tell you exactly that, and also give you a plan on changes that you need to make, whether it's your income or down payment, in order to be eligible to buy your first home. Now, assuming that you know that you are buying a house this year, here, the other question that a lot of people will have in their heads is, now that the variable rate has started to come down, should we go with a variable rate mortgage or a fixed rate mortgage? And the answer in general is still fixed rate. And the reason is that the difference between fixed and variable rate, fixed rates are still about 1% lower than variable rates. Now, the biggest advantage of going with variable rate is that the variable rate penalties if you break the mortgage is very, very low. However, if you do the numbers a little bit, and I'll just give you overall numbers, the reason why you break a mortgage is that you need better interest rates in 1 to 2 years, because we all know, even though the Bank of Canada might not reduce interest rates that quickly this year, but in the next 2-3 years, the interest rates will come down. They'll probably come down under 4%, very soon. And therefore, you might want to break a mortgage to get into a better interest rate. The other reason to break a mortgage is that you're upgrading your home. Now, there are options of portability that we discuss, depending on your situation. And third and pretty common reason right now is that you're selling your home and leaving Canada, and therefore you have to break your mortgage. But if you look at the numbers, right now at a $500,000, let's say you have a $500,000 mortgage at a 25-year amortization and you're doing a less than 20% down, your mortgage payment at variable rate, let's say is 5.95%, will be about $31.84. However, if you take a 3-year fixed rate, I'm not even talking about a 5. I would never recommend anyone taking a 5-year fixed rates unless you are absolutely not eligible to buy a 3-year fixed. And right now, the 3-year fixed rate is under 4.8%, and the mortgage payment is more than $300 lower to start with. Yes, the variable rates are coming down and they might come down even more next year. However, the gap between the fixed and variable rate is more than 1% right now. And to club that gap, I think personally that it will take at least 2 years. And in those 2 years, you will be saving the difference, which to start with is $300. So any higher penalty that you will have to pay if you have to break the mortgage, let's say in your 3rd year, that will be more than compensated by the differential in the payment that you start with. So if you're buying your first home, I'll still recommend to go for a 3-year fixed mortgage and then relook at the interest rate and your entire structure after 2 years. There's only one reason why you should take a variable rate mortgage, and that is if you're doing a flip or if you want to do a burst strategy where you have to refinance within 6 months or 1 year. And in that case, I would still recommend you either go for a 1-year fixed or a variable rate just to reduce on the penalties and move into a lower interest rate when you are refinancing. I hope this video provides some clarity on how interest rates work and what you should do if you are a first-time home buyer. If you liked anything in this video, do hit the like button so that more people like you can benefit from what I put on this channel. If you have not subscribed to the channel, do make sure that you hit the bell icon as well so that you do not miss the videos when they come. मिलते हैं अगली वीडियो में, तब तक के लिए बाय बाय।